Welcome back to the Bitcoin Treasuries podcast. I'm Tim Kotzman. I'm here with Tim Enneking, the founder and managing partner of Salion. Tim, thanks for joining us today.
Thanks very much, Tim. I really enjoyed our earlier conversation, so looking forward to continuing.
Well, you mentioned that you had a few stories, so we thought maybe this would be a great opportunity to learn more about you, your background, and your journey to Bitcoin, and some of the storied past that you have in the space.
Yeah, it's been a heck of a ride. I didn't really give up the fiat side of things. I just added crypto to it or digital assets to it until last summer, at which point in time, at that point in time, I was also the CIO, the chief investment officer of a healthy 9-digit family office that did no crypto and had a good 9-year run. I tripled the assets there, but it was just getting to be too much. So now I'm totally in the digital asset space.
Got it. Could you take us back a little bit of your background and your journey to where you are today?
Sure. In terms of background, just the education stuff, I guess the only thing unique there is I have 5 degrees, which is a bit weird. I speak 4 languages, and I was living in Moscow of all places. And this group of people saw me doing a presentation on the fund I ran that was a Eastern European focused fund of funds, which for my sins, as far as I know, still has the all-time annual and all-time monthly performance record for a fund of funds. But that happened because of what's coming in a bit. So, I do reasonably well in presentations, and these guys said, how would you like to be the master of ceremonies at our award ceremony in Porto, Spain, where we're acknowledging a lot of our new clients because they had started a Malta-based sort of one-stop fits-all exchange. So you could do everything from FX to crypto to stocks and bonds, and the whole shebang. And kind of like an Interactive Brokers competitor. So I had this big event in Porto, and this is December of 2012 or January 2013. And so I said, sure, I'll do that. And they got to know me better. And after a little while, they said, hey, we have a fund and we need some help running it because we've never run a fund. We set this up and it's called the Bitcoin Fund. And they described what the fund did. So people subscribed for the fund. It bought Bitcoin. They redeemed from the fund. It sold Bitcoin. And I just looked at him and said, well, that's really cool. There's no discretionary management, but what the heck is Bitcoin? I mean, I'd literally never heard of it at that point in time.
And what year was this?
And this was in either December of 2012 or January 2013.
Okay.
And I dug into it. They told me initially what it was. I read a little bit about it and said, this is the absolute stupidest thing I've ever heard. What is this? This isn't money, right? Traditional TradFi reaction. But because they were building a good business, had quite a bit of AUM or assets under management. And I said I was going to manage the thing because there was no discretionary management involved. I figured I better climb the learning curve. And in my mind at the time, Bitcoin was down here someplace and fiat was way up here, right? That was the gold standard, pun very much intended. And so I started digging into Bitcoin, and I read about Charles Ponzi in New York and pyramid schemes. And I read 2 full books on the tulip crisis or tulip mania, which now, we sort of think, well, must have been like 2 months, but the tulip mania from beginning to end was almost 6 years. Straddling the 16th century and the 17th century. So, late 1500s to early 1600s. And I read all this stuff. And in fact, this group of guys from this exchange, they were laughing at me so hard. They actually made the theme for the awards ceremony in Porto, Spain, was the Dutch and the tulip crisis or tulip mania. And it gave a nice possibilities for decor. But anyway, I dug and I really, couldn't find anything dramatically wrong with Bitcoin, but it was still really novel to me. So I thought, maybe I should look at the other half of the equation and compare it to, and look at what fiat is, look what the US dollar is, look at what the euro is in more detail. So I started digging into regular money, right? Fiat money. And among other things, figured out what the word fiat was, right? It's not just an automobile manufacturer in Turin, and thought, it's sort of odd that it's just fiat money exists because somebody says it exists, a king initially, and now governments. So I dug into it more and more. And I mean, I literally spent a week walking around. I was living in Moscow at the time and working there. And I thought, my gosh, I can't believe how fragile the economic system is, because what I realized was that, since August 15th, 1971, fiat money, which has never really been 100% backed by gold by any standard, is really not based. It's a question of faith. Fiat money is almost a religious question. And I thought, whoa, it really shook me up, because I thought the underpinnings, like virtually everybody, right? Even today, even people who do crypto, they haven't really done an analysis of what fiat is. And then I realized, wow, the difference is, it wasn't so much that Bitcoin had moved up in my mind, but fiat had moved way down. And then I always use the example of Cyprus, because Nixon finished what Roosevelt started and completely took the U.S. off the dollar standard. And by the way, the U.S. was never, ever by law backed more than 40% by the dollar. And the first law that formally backed the dollar with gold wasn't passed until 1900. So there's a lot of misinformation about what fiat was backed by at one point in time, all of which I learned because I was digging into it. So in 1971, when Nixon finished what Roosevelt started, took the U.S. off the gold standard, within a week, every currency on the planet did the same thing. So Bretton Woods, fixed exchange rates, 1946 in New Hampshire, that's all done and dusted. So now exchange rates are floating because currencies are no longer anchored to the U.S. dollar. And I thought, wow, that is something I knew nothing about. So then fast forward 3 years, 1974, Cyprus. Bunch of Greek colonels take over the southwest 2/3 of the island of Cyprus. Turkey invades from the north, takes the northeast piece of it, and you got this little island in the eastern Mediterranean that has 3 international airports. One, because the Green Line, where they finally stopped fighting, runs right through the middle of Nicosia Airport. Nicosia was the former capital of United Cyprus. And in the south, they built an international airport. In the north, they built an international airport. So very odd situation overall. And why do I bring it up? Because the Cypriot pound, which existed and was backed by some gold, a little bit anyway, what totally disappeared with the invasion, and so did the gold. And Cyprus declared a new currency, the new Cypriot pound, in 1974. That was the first currency created after Nixon's declaration on August 15, 71. The Cypriot pound became one of the few currencies in the world that was nominally stronger than the US dollar. So it took $4 to buy a British pound at the time. Now, things have changed since then, but it took $2 US to buy a Cypriot pound. So here you have this currency that was backed by nothing, created out of thin air, and everyone accepts it as actually being a very strong currency with a strong exchange rate relative to other fiat currencies. And so then, as I tell this story to people who aren't familiar with Bitcoin, although there are fewer and fewer of those nowadays, my question became, why is it that 1.6 million people co-located on an island in the Eastern Mediterranean can create a new currency out of thin air, and 1.6 million people who aren't co-located on the same island can't? And that one example to me, as I was going through this, just blew everything up. And I said, okay, as long as people are willing to accept it, virtually anyone can create a currency. The question is, will other people accept it? And now people accept Bitcoin, they accept legitimacy, they accept that it's deflationary. There are only about 21 million of them, and probably 2 million have been lost already. That is a psychological approach that has some appeal, and that gives it value. And you look at the US dollar and you think, okay, it's not backed by anything, but the Federal Reserve issues some, takes some back. Almost everybody is willing to accept it. It's the de facto reserve currency. But the story there isn't inherently far more compelling than the story around a cryptocurrency or a digital asset that is also willingly accepted by other people. And it really changed that whole story, looking at the history. And I went back to Roman armies and IOUs and other things where you had parallel currencies. And my fund that was focused in Eastern Europe, instead of shutting it down, which I was planning on doing because I didn't like what Putin was doing in 2013, and this is well before Ukraine and everything, rather than shut it down, I turned it in later in 2013 into the world's first crypto or digital asset trading fund. And let me stop there because I've been rambling for a bit.
No, I appreciate the history, because I think all of this sets us up for a couple of the firsts that I think, one of which you've already mentioned, which was the Bitcoin fund. I think there's another first that you're going to get to, and then ultimately maybe we'll get to what's going on today. So yeah, no.
Well, let's go to the yield. I mean, the second first, if you will, was when I created what I understood to be the world's first trading fund, cryptocurrency fund. I converted my Russian-focused fund of funds or Eastern European-focused fund of funds to cryptocurrency fund, which I understand is the first crypto trading fund in history, and then shut it down. I moved back to the U.S. It was an offshore fund, can't really run that from the U.S., and created another crypto fund in the States that is now 8 years old. But of more interest, I think, to you in this podcast is 5 years ago, finally put together a group of people that I'd been looking for a while and created two lines of business. One is what's called in crypto yield farming, or allocations to liquidity pools to generate yield. And the other is a couple of VC funds, and we're now about to launch our third vintage of the VC funds. Those weren't the first, but as we understand it now, we run the largest yield farming operation or liquidity allocation operation in the world. And the company we created is called Salion in English. It's P-S-A-L-I-O-N, so Salion, for example, in French. But there all the good modern language words were taken. So Salion is ancient Greek for chain. So that's what we set up 5 years ago, and both sides of the business have been going really, really well.
Bitcoin custody is evolving, and OnRamp leads this change with multi-institution custody, eliminating single points of failure. Instead of one institution or complex private keys, OnRamp secures your Bitcoin in a segregated, cold storage, multi-sig vault backed by 3 independent, institutional-grade custodians. No single custodian can move funds by themselves, providing an unprecedented level of security that traditional custody solutions simply can't match. Protected by a $100 million Lloyd's of London insurance policy, all transactions are fully auditable on-chain, never rehypothecated, and executed only at your explicit direction. This means complete transparency and control over your assets at all times. Beyond custody, OnRamp delivers comprehensive Bitcoin financial services, including lending, trading, inheritance planning, IRAs, and more. OnRamp functions as your private banking partner, coordinating key holder activity, removing technical burdens, and providing a personalized, trust-minimized experience tailored to your specific wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, OnRamp's approach helps secure generational wealth with unmatched security and peace of mind. Visit onrampbitcoin.com today to learn more, sign up, or book a free consultation with their team of Bitcoin custody experts. Are you looking for comprehensive analytics on corporate Bitcoin adoption? Strategy Tracker delivers real-time insights into how companies are executing their Bitcoin strategies completely free. Monitor NAV premiums, cost basis performance, and track how corporate Bitcoin treasuries perform against the market. Upgrade to premium for just $3.99 a month and unlock exclusive benefits like detailed market rankings, real-time trading volume analysis, and advanced performance metrics for corporations embracing Bitcoin. Apply code KOTZ at checkout for 100% off your first month of premium. Strategy Tracker is your essential tool for measuring the effectiveness of corporate Bitcoin strategies. Visit strategytracker.com and gain the analytical edge in understanding the Bitcoin Treasury phenomenon. Join us at the Win in Las Vegas, February 23rd through the 26th, 2026 for Bitcoin for Corporations. Use code KOTZ when you grab your tickets at strategy.com, and we'll see you there. Where, in your view, does all of this go over the next 12 to 36 months? Like, what is the place and time maybe that we're in when it comes to Bitcoin and the rest of digital assets, and where is it going from your view and everything that you're involved with?
You know, it's funny. I very modestly took over Moore's Law and something I now call flippantly Enneking's Law. And that is that the profile of the average Bitcoin investor, crypto investor, changes every 18 months. It evolves every 18 months. So at the very beginning, you had libertarians and real, you wouldn't have called it them at that point in time, but anti-fiat guys, anti-US dollar guys, because of quantitative easing from the Great Recession in 2008 and 2009. And then it went more to bleeding edge tech guys, and then it went slightly more mainstream tech guys. And without going through each generation, if you look about 3 years ago, you started to see a little bit of movement into small cutting edge financial institutions. And then about 18 months ago, it was larger financial institutions or even large ones who sort of very quietly got involved in crypto. And then in the last 18 months, you've seen large financial institutions get more involved. Some still, it's ganz verboten, but others, they're more than putting their dipping their toes into it. And then in the next 18 months, where we go forward with this, you're seeing a bit of it now, and that is private companies and increasingly public companies who start adding Bitcoin to their balance sheet, not because it's a reserve currency, but because it's a reserve asset. What we haven't seen, and I thought it would move a little bit faster, are countries putting Bitcoin on their balance sheets. There's some of that, probably more than we realize, but it isn't all that large scale yet. So if I look where we're going, and from the optic of, how is the profile of the average investor going to change? Because let's face it, it's the investors, it's people who are buying and selling it at radically varying degrees of frequency that determine price movement. So if the profile of the average investor is evolving, the price is also evolving, and trading patterns also evolve. And we've seen trading patterns just change radically over the last, since I've been involved, dozen years. And so where we're going next are more and broader major institution involvement, more private and public companies adding it to their balance sheet. But the real change is going to be more sovereigns. You have Bhutan that is got a $1.5 billion worth of crypto, Bitcoin, because it was mining. You've got El Salvador buying at least one Bitcoin a day. So it's about, I think, 700 million now that they have. And there are the United States, Trump ordered everyone to consolidate their Bitcoin. So it turns out the US has almost a quarter million Bitcoin, which is quite phenomenal. Spread out across the government, and now they're trying to consolidate it. And there'll be a lot more of that from a major perspective, which means, as I've been saying for a little over a year now, crypto, the whole that people view as crypto is going to fragment. Stable coins are going to move out of crypto because from a lot of perspectives, they really aren't crypto. And in fact, they're stable because they're underlined by fiat, which I called hypocrisy arbitrage in a speech I gave once. And then you've got Bitcoin, which is really becoming sui generis. It's becoming its own thing, its own category, sort of like gold with respect to precious metals. It's just different. And then within crypto, what's left, the other thing that's probably going to spin out kind of for the same reason that stable coins did is RWA assets, because the tokenization is just a specialized form of securitization of assets, of traditional assets, especially real estate, which is what everybody is trying to chase after. So all of those trends, they've already started, and they're all going to continue and accelerate. And then you're going to be left with a hardcore of crypto that everyone will agree is crypto. And over time, that will probably continue to grow into more verticals that are further and further away from each other. I hope I answered the question.
Yeah. You sometimes hear this narrative of institutions, or let's say governments, larger players need the price of Bitcoin to be higher than it is now before they would feel comfortable from a volume or liquidity or asset size perspective of like dipping their toe into it. Do you think there's validity to that, or how do you think through that? Or maybe you can even put it in a different way from how I described it.
Well, I think you're describing a very legitimate application of an equally legitimate principle. I used to say 10 years ago that, pardon my French here, but crypto didn't amount to a pimple on a gnat's ass, as the phrase goes, right? Because it was so tiny. It's gotten bigger now, but at the end of the day, it's still not all that large. The total, people say, oh, the total market cap of Bitcoin is now the 15th largest country in the world, equal to the GDP of the 15th largest country in the world. But that's really comparing apples to oranges, because that GDP is generated every year by every country on the GDP list, whereas the crypto market cap is a static figure. Now, you could look at crypto trading if you wanted, or Bitcoin turnover on an annual basis, and you get a nice large number, but a lot of that is churn with the same players going around. So it's a bit misleading often when you look at many of the figures that people cite for how big and bad crypto is. It's actually a very, very, let me take one very away. It's a very small asset, or it's a relatively small asset class. And if you're a multi-trillion-dollar bank or financial institution, as many are these days, the putting 10 million here or even 100 million there, it's not going to move the needle. And as I mentioned, I used to be an M&A, and one of the things that was very clear, if you did $1 million deal or $100 million deal, the due diligence and all the work you had to do for the $1 million deal it'll be less than $100 million deal, but not a lot. And it's certainly not 1/100th of it. So if you're asking a large financial institution to make an investment that for that financial institution is relatively small, you're asking for a massive allocation of resources, regardless of the scope and size of the deal. So to justify that, there has to be a lot of there. It's not just a one-off $100 million deal, which to you and me is a lot of money, but for them, they need to have a $1 billion market, a multi-billion-dollar market that's deep, where they can sell $1 billion on a given day of a given asset and not move the asset at all. Compare it to FX markets, where you have something like, it's almost $10 trillion a day in trading. Compared to that, the entire crypto market is just tiny. So it's not so much that in the abstract, okay, the Bitcoin price has to be higher. It hits 200 and we'll get in. It's not so much that as the entire sector has to be larger and deeper, right? There has to be just more trading volume. So it's not so easy to move markets when you do what for those large financial institutions is a medium or even a smaller size transaction. You just can't do that yet. In Bitcoin, which is, now it's almost 2/3 of the entire market. So if you can't do it in Bitcoin, you sure as heck can't do it anyplace else.
How do you think about AI when it comes to Bitcoin and digital assets and how they intersect? The one narrative that I sometimes bring up is you may not be interested in Bitcoin, but the AI agents are going to be interested in Bitcoin to transact in that native online way. Do you think that AI application sort of helps the Bitcoin narrative? Doesn't really help it? How do they intersect, or how do you think about AI and anything else that maybe comes to mind intersecting with Bitcoin?
I think it will help it, but of the various options you picked, is there some sort of inherent connection between the two? I would say absolutely not. I find most of the AI projects in crypto, they're really kind of being shoehorned in, or a square peg round hole, pick your metaphor. There really isn't anything inherent in both of them that says, these should both stand up and sing Kumbaya at the top of their lungs. On the other hand, I was just talking to a guy from a large financial institution that's looking at our liquidity allocations and our yield. And I said to him, I said, look, if I took what we're doing, and so you're getting 12% a year with a Sharpe ratio of 8, which, anything above 2 is great. 3 is almost unheard of. And we got one at 8. And you're getting this yield, and it's US dollars, and you have 6-hour liquidity. Or if you want to go hedge fund, you have 30-day liquidity. Describe that whole thing, but leave out the fact that there are stable coins involved. And leave out the fact that the liquidity pool is not on a NASDAQ, because the NASDAQ has a liquidity pool too, but is in crypto where you have multiple liquidity pools because they're binary. You've got one asset on each side. Leave those details out. Just describe the performance, 5 years of history, no losses ever in any allocation or any day. And if you took out those words crypto from that, every fiat investor on the planet, well, almost every fiat investor on the planet would go, holy crap, that is really good. Let me do that. But because they're afraid of crypto and because they can't look at crypto objectively, that makes it much more questionable whether they actually be interested in that. And AI doesn't have, let's call it the handicap or the benefit of human emotion. So if an AI is looking at a range of investments and looking at objective criteria for those investments, some are crypto, some are not, some are fiat, right? Some are digital, some are TradFi. An AI agent who is purely looking objectively at crypto investments, in particular Bitcoin, would be much more likely to effect an allocation to those assets than your average TradFi person who is, has a lot of experience, has barely heard of crypto, and because most of the money is still controlled by, an older generation, which is more reticent to go into crypto. From that perspective, an AI investment agent, I think, would be fabulous for the sector, because there are some really good investments in the sector that are very different from what people think they are, but crypto is very broad right now. And so I think ultimately it would be very positive for the sector as a whole.
Any view on the Lightning Network and other kind of layer 2 using Bitcoin as a medium of exchange sort of aspect to all of this? Because a lot of the material and people we talk to in the Bitcoin Treasury space certainly are, let's say, neutral as Bitcoin goes on payments, and very focused on, as you described it, Bitcoin as an asset, as digital collateral, as whatever words you want to put together, right, as a property and not a currency.
Yeah, I think you got to step back and look at the historical definition of money. And again, I dug into this so much before, most of it stuck. So you have three characteristics historically of money. One is a unit of exchange. One is a unit of account. And the third is a store of value. So medium of exchange, unit of account, store of value. I would add a fourth, this is just me talking, in the modern world, and that is transferability. Because you could say gold is a currency. Well, not really. It's kind of hard to transfer it. It doesn't transfer electronically very well, and it also is kind of difficult to carry around. And I think to some older forms of money where people would literally carry enormous copper sheets, if they were wealthy. And Bitcoin doesn't fit those. Let's use all four. It is clearly not a medium of exchange. It's used a little bit, but not very much. And when people use it, it's to gain headlines. Someone bought a house. What do they do with the Bitcoin? They sold it for Bitcoin, and they immediately, within a nanosecond, transferred into fiat. So yes, technically, kind of, sort of, but not really. And so it's not a medium of exchange. It's a unit of account to a very, very limited degree. Although there are more and more people that will create, even companies that will have two sets of books, not in the negative, I'll show this one to the tax collector and I'll keep this one for real, but they'll have one fiat denominated set of books, another crypto denominated set of books for different transactions. But it's still really not a unit of account. Store of value, absolutely categorically Bitcoin is, and transferable. It's, ultimately transferable. So it's great from that perspective. It's not, I don't see BTC ever really becoming a unit of exchange or a medium of exchange or unit of account, mainly because the volatility is still too high. Should that at some future time be reduced? Okay, great. But I don't think it's all that important to Bitcoin. It may be slightly negative because people are going to lose it or whatever, or do silly things with it. But L2s have been, with ordinals and runes and lightning and other things, L2s have been sort of the supposed holy grail of Bitcoin, to use the Bitcoin blockchain. But I just really don't see it. The blockchain really isn't structured to do massive amounts of business on. I realize you can offload it on side chains and do a lot of other things technologically, but why? It's still, to me, kind of forcing something on the Bitcoin blockchain that, yeah, you can do it. Yes, it's interesting, but I don't think it does a lot to really add any, fundamental value to BTC. Personally, I'd like to see it because we do the liquid, the LP allocations to liquidity pools. I'd love to see it because more transactions mean more fees, which should mean greater yield. But honestly, I'm much more concerned about seeing stability and strength in the Bitcoin blockchain than I am worried about people, whether they should add more stuff on top of it or not.
What's your view on all of these Bitcoin Treasury companies, from Microstrategy to MetaPlanet, and they seem to be popping up in different jurisdictions, and Michael Saylor in particular coming out with new and novel preferred products to tap these different capital markets? Like, is this
right
going to be or continue to be like a significant? I mean, I think this morning there was actually a report out that the treasury companies are now outpacing the ETF complex. So, I mean, what's your view on all of that today and where that's going?
Well, first of all, I don't think Michael Saylor should have renamed MicroStrategy as strategy. I think he could have called it Macrostrategy or MetaStrategy or something. Strategy is just too generic. I love what he's doing because he was the first one to really solve at scale the question of how do you borrow money cheap and invest it in crypto for the long term. And if he's selling stock, he's not even borrowing money, right? He's getting it at zero cost. And with over 500,000 BTC, it's just amazing what he's done. I think 2 days ago, he announced another $1 billion purchase. basically tapping through stocks and bonds. He's not actually being all that creative in how he collects the money from the public markets. He's being exceedingly creative in what he's doing with it because he's just buying BTC. And interesting, when you look after the fact, when reports come out of how many BTC he bought and at what price, whoever's doing the buying at Strategy isn't all that good a trader. They're more doing what I actually recommend investors don't do. You have money in your pocket, therefore you got to invest, you got to buy something. Strategy isn't particularly patient about buying. If they were, they'd be in a lot better position than they are now. To some degree, probably they've raised money on public markets for a purpose. They don't want to wait too long, but 30, 60, 90 days of patience would do Strategy really, really well. But as I said earlier, in answer to your other question about where I see things going, I think there are going to be more and more companies doing that. Not obviously to the scale that Strategy is, and I forget the Japanese company that people are now calling the Japanese Strategy. They're more and more. That's just going to happen as companies allocate a little bit. Doesn't make headlines. They may be private companies. If they're public, there'll be a footnote someplace, if that, because it's not material. But I think there's a lot more of that going on even now. And if you look at what the Bitcoin price has done, it finally broke through the 69 ETH that was parked all-time high, where it's parked for so long. And now it's done exactly what I expected to do at 100. I had a friend of mine said, well, when do you think Bitcoin is going to cross 100? And I looked at him and I said, I think Bitcoin is going to cross 100 51 times. And he goes, that's amazingly specific. And I said, well, not really. It's just a whole bunch of times. And it's an odd number, which means by the time it's done vibrating up and down around 100, it's going to end up above 100. And we'll probably see a 9 handle again before too long. But I think basically we can now say Bitcoin is above 100. Huge psychological resistance level, and now turning into a support level. Once the psychology of the traders, see my point about every 18 months them switch, the psychology of the profile of the average trader changing. Once everyone believes that 100 is the floor, we're going to see a real move up, and the scarcity value of Bitcoin is really not been recognized for the reason you mentioned. Private hands, or public company, but in non-trading hands, hold more Bitcoin than ETFs do. And ETFs can actually be traded. They're less stable than, say, Strategy's pile or the US government's pile. Those piles are not going to hit, or those bags, as people like to say in the crypto space, are not going to hit the market tomorrow and leave and come back and leave and come back. They're just sitting out there. So the number of Bitcoin that are being actively traded, when you back out those that have been lost, when you back out Satoshi Nakamoto's 10%, when you back out some of these big piles of BTC that we know are being held because we can see them on the blockchain, the wallets are identified, you have a remarkably rapidly shrinking amount or number of Bitcoin that are eligible to be traded. Yet at the same time, you have more people interested in buying them, and you have deeper pockets that are interested in buying them. And this, again, take out the word crypto and describe that in a neutral setting. Oh, here's this commodity that has this, all these characteristics. And everybody would go, my God, I want to put my entire fortune in. That's insane. Everything is lining up to send this through the roof. Then you say, oh, it's Bitcoin. Well, no, I don't want to do that. But if you look at it objectively, almost back to your AI agent question, Bitcoin now is set up for a move to the mother of all moves, as the phrase goes, because of the various trends that you just mentioned.
This episode is brought to you by Arch Lending, the premier provider of crypto-backed loans designed for both individual and institutional investors. At Arch, your digital assets work for you without selling them. Arch offers flexible loan options tailored to your needs. Backed by industry leaders like Morgan Creek Digital, Castle Island Ventures, and Galaxy Ventures, Arch Lending is setting a new standard in crypto-backed lending. Are you ready to unlock the potential of your crypto assets? Visit archlending.com to learn more and configure your loan today.
Europe's richest Bitcoin heritage site, Prague. BTC Prague, the biggest Bitcoin conference on the continent.
Join us June 19th through the 21st for Bitcoin Prague 2025. Use code KOTSMAN when you buy your ticket at btcprague.com. Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. Can you walk us through Bitcoin yield as far as what is it? How does it work?
Sure, absolutely. And like I do now when someone asks me to explain what is Bitcoin. In fact, it happened last Friday in a very lovely outdoor restaurant in San Clemente. And the guy, explain to me what Bitcoin, what digital assets are. And I said, no, I'm going to explain to you what money is because you don't know what money is. And this was a guy who was a CPA and an actuary. He was like offended. And by the time we got done, he looked at me and said, you're right. I didn't know what money is. This is amazing. I can't believe how little I knew. We're going to start talking about liquidity pools and yield in Bitcoin by talking about fiat. Because the vast majority of people do not know when they buy and sell stocks, whom they're really buying stock from and to whom they're really selling the stock. So you have a marketplace. Let's just take the NASDAQ, right? And you've got Meta and Amazon. And in the morning, you've got your 10,000 shares of Amazon stock and you want to sell them. What are the odds that exactly at that moment, there's another person that wants to buy 10,000 shares of Amazon stock at the exact price you're willing to sell it? The odds are not zero, but they're really, really tiny. And then in the afternoon, somebody else wants to buy those 10,000 shares at Amazon, and he or she will do so. Since almost stock markets were organized, there is an intermediary there who buys the stocks and sells the stocks. And the intermediary is called a market maker for obvious reasons. So MMs have existed for well over 100 years. And I liken it to, they're the grease in the gears that allow the gears to turn. And it's something that every regulator encourages. You want there to be multiple market makers. You don't want there to be one because then they can, juggle the bid ask on each side. A bit less so now, but with high frequency trading, a little bit goes a long way. And the market makers are the ones that actually are doing the vast majority of the buying and the vast majority of the selling. I'm ignoring things like dark pools and a few other esoteric, relatively recent things, just keeping it very, very simple. And fundamentally, this is how fiat markets work. It takes a lot of money to do that. Your 10,000 shares of Amazon and somebody else's and somebody else's and somebody else's. Hundreds of billions, if not trillions of dollars of money flowing through market makers. And they offset the risk and they make money on this and they're hedging, et cetera, different line of business. But for this purpose, what they need is lots of money. They need lots of cash. And they go to LPs, not limited partners. They're liquidity providers. And they borrow them or they lend the money to the MMs, and the MMs do their thing on the market. And the LPs get a decent return on that. It's, LIBOR or SOFR plus 200, 300, 400 bips, depending on how big they are, depending how long term they're willing to make the loans. And it's a good business. You don't hear much about it. There are half a dozen actors on each side, and it works very well because we're all able to buy and sell securities, stocks, shares of stock when we want to. That exact principle, it's just the grease to turn the gears to make markets run efficiently, also applies to crypto. Every digital asset market needs MMs and needs LPs. There are two major differences. There are a bunch of small ones, but they're two, one medium-sized and one major difference, but they don't fundamentally change how things work. The medium-sized difference is 24/7 versus market open, market close. Digital asset markets, if you count the number of hours, I did this once, I published an article someplace, CoinDesk, that digital markets are open 5.5 times as many hours as fiat markets. With the exception of the LSE, which is open 8.5 hours a day. It's the longest opening hours of any major exchange in the world. So that's a difference because MMs can settle with LPs on fiat markets, although fiat markets are now starting to extend, and I submit in the next 3-4 years, we'll see 24-hour trading in most stocks as well. But that's more a mechanical difference. It's not really all that fundamental, which why I say it's medium-sized. It's important to traders, but as for the plumbing, it's something they can work around. The big difference is the structure, and that is you have 5 or 6 massive liquidity pools that cover the NASDAQ. About 3,500 shares of stock are traded on the NASDAQ. One liquidity provider will cover 1,000, another will cover 1,500, another might cover 2,000. But between the liquidity providers, the securities exchange regulators, and the exchange itself ensure that at least everybody is covered by at least one and hopefully more liquidity or market makers. In the digital asset space, it's binary, particularly on decentralized exchanges, on DEXs. So you have ETH on one side and you have BTC on the other. And people are buying and selling. There's this liquidity pool to which LPs, liquidity providers, allocate their liquidity. And the MMs in this context are called AMMs, automated market makers, which are smart contracts effectively. And the difference, a smart contract versus a company, really isn't as big as it might sound because MMs on fiat markets are all automated today anyway. So what you have is the people allocating liquidity to this pool, but both pools, both prices on either side are shifting. And it's not one goes up and the other goes dollar terms. They could both go up and often do, or both go down and often do. And so you can have losses which are impermanent losses, lovely name, impermanent losses, depending on which price is moving where. And when you allocate to liquidity pool, you have to do 50% on each side, and it may turn out to be, 45 and 55, or it'll shift around or whatever. And there's an interesting investment approach to allocating to liquidity pools where you think both component assets are going and timing going in and timing going out. It's a really fascinating investment thesis, which is different from the fiat investment thesis because the market maker is trying to make a slice of each transaction, hedging the risk of pricing changes. The LP doesn't see any of that. It's completely transparent or opaque. I guess they don't see any of it to the LP. They're just doing basically a loan. Liquidity provision in crypto space is not at all a loan. It's variable. You get LP tokens for allocating to liquidity pools. It can be a very, very sophisticated game, much more complex than being an LP on the fiat side because the crypto liquidity pools are binary. And I don't want to turn this into an ad for my company, but what we do is an interesting subset of that. There are some liquidity pools like Bitcoin on 2 blockchains or USDC and USDT, where you effectively have the same asset on each side, and you can allocate to those liquidity pools without market risk and without impermanent loss risk. And so there are possibilities within the crypto space that don't exist within the fiat space. They're kind of at the margins and they're not infinitely large, but they're very, very interesting places for people to earn a relatively low risk yield. And with Bitcoin, because you have wrapped Bitcoin and various other flavors of Bitcoin wrapped for different blockchains, you have all sorts of different pools that are a bit obscure, admittedly, but they've effectively got the same asset on either side, and you can earn a little piece of the various transactions. It's one of the ways where, in general, the digital asset markets run the exact same way as TradFi markets run. But if you dig down into the nuances on either side, you can find uniquenesses, and sometimes they're good for investors.
So sometimes I see on social media, you can own a digitized or fractionalized piece of this artwork or this, piece of real estate. Are you in some sense saying that people or yourself or someone that's working with you is almost becoming like a fractional owner of these liquidity pools, or would that not be accurate?
You don't become a fractional owner of the liquidity pool because liquidity pools are always associated with exchanges. So by definition. And the other thing with liquidity pools is you're not taking a position, except in a very, very transitory sense, on either side of the liquidity pool. RWA, which is what you're talking about, is actually really quite interesting in that regard. Because let's say the example I used to use 10 years ago, let's say you tokenize the Mona Lisa. And you've had this you've had the possibility in TradFi markets for probably 50 years to securitize something. It was initially done just with financial instruments. And we know from the Great Recession, it doesn't always work. You take a whole bunch of mortgages, bundle them together, and then you issue some sort of security on that bundle. And at the time, the magic was we're going to take a whole bunch of C and D rated mortgages, put them together, hope that the various any defaults and stuff cancel each other out and become just a very low background noise. And we're going to issue AAA or AA bonds against those securitized assets. Well, we all know that didn't work particularly well. But the securitization concept is very well known. And so traditionally, how has it happened? You had to have massive billions of dollars of assets. Why? Because it was expensive to securitize. Just the process itself is very difficult, very cumbersome, involves a lot of intermediaries, and they all want to get their slice. So, and then in addition, you don't have a lot of buyers. You may securitize this bundle of let's stick with mortgages or office buildings, let's say, and you may only have 10 buyers for the whole thing because you're not going to offer it to the general public. Way too many problems with that. Enter RWA or tokenization. It's simply securitization with much less granularity. I call it atomization, right? We're not securitizing the ownership, we're atomizing the ownership. So we're going to allow there to be 10 million owners of this $1 billion portfolio of office buildings. Haven't quite gotten to that level yet, but that is the idea. And regulation crowdfunding in the US, which is sort of the US regulatory answer to ICOs, okay, we're going to let small investors invest in startups, still very cumbersome, far more cumbersome than ICOs, but also a lot less fraud than you run into with ICOs. With RWA, you've got the same sort of issue. How do we get this out to the general public in a way that is compliant from a regulatory perspective, and in a way that still offers the small investor an opportunity or preserves the opportunity for the small investor? One of the big issues with that is, where do you create the market? Because people probably aren't going to buy and sell a given token from a real world asset with all that much frequency. So do we create a ring-fenced AI only, credit investor only exchange, or what do we do? And that leads to your question in terms of the yield farming, in terms of generating yield, in terms of allocating to those liquidity pools with real world assets, or the tokens from the tokenization of real world assets, to allow them to be traded. And the fact of the matter is that question's still open. No one really knows where that's going to go because there aren't good markets. There's not there's not full and free information, as the phrase goes, on tokenization. So it's a bit premature to look at that now. But ultimately, when far more things are tokenized than they are today, and where you have markets that are able to deal with tokens that don't have a lot of trading volume in them because they're static assets, you'll see a lot more exchanges adding a whole nother vertical to what their business is today. And liquidity pools will follow that very definitely. I hope I answered the question.
Yeah, definitely. Appreciate all the time today. I feel like we could probably cover another hour or two worth of information and
well,
topics.
As you said, let's do it in a couple of months when you have a slow spot to fill.
Yeah. But I'll throw it over to you for any final thoughts, and if you could let everyone know where to find you and your firm online.
Sure. No, really enjoyed the conversation, Tim. Thanks very much. And the fact that we have the same first name didn't cause as much confusion as I thought it might. If you want to look up me or send me a note, feel free to. It's very cleverly tim@salion.com, and Salion is, again, a silent P, so PSALION. We have a number of interesting businesses that we're involved in, and I'll leave it at that. But really enjoyed this. I really like telling the story about how I got into Bitcoin and how I got into crypto, because I was at least as skeptical as the most skeptical people you've ever run into, or any of your viewers have ever run into. But if you look at it objectively, and I guess I would end with this piece of advice, if you want to understand digital assets, you need to understand TradFi assets. Because even people who have spent 50 years, their entire careers, dealing with dollars and euros and pounds and fiat, they actually don't know what it really is.
It's a great place to end it. Tim, thanks so much for your time.
Thank you, Tim. Take care.